Hello, very good morning to all. Welcome to today's Daily Dose of Market Insight. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Very good morning and happy Friday. Today will be the start of a brand new month, the 1st of March 2024. So before we jump straight into our Daily Dose of Market Insights, let's have a look at the disclaimer slides first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses could exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so well, before we jump straight into the short-term technical outlook on the broad-based asset classes, which is the gist of our daily dose of market insight, let's have a recap of what happened yesterday. So yesterday itself was a key pivotal moment in terms of the key US data release, where we have the core PCE inflation data. Why is it important? Because that set of inflationary data is a preferred gauge of inflationary trend that the US central bank monitor, which indirectly or directly determine the cost of their monetary policy going forward. So yesterday, PCE print itself, yes, we do see a lot of newswire reported that the core PCE print on a month-on-month basis jumped to 0.4%. So that's actually the highest level close about a year. So let me share with you the data point over here. All right, then before market, how the market reacted to it. Then I'll explain to you why the market react to that data. All right, so what you could see at this point in time, the core PCE print, let me share with you. Yeah, this is the month-on-month. So why I look at core PCE, because that is a much more demand pull sensitive inflationary print rather than cost push sensitive. That means I exclude out the fresh food, exclude out the food and energy prices. So this number of 0.4% print, higher than 0.1% print month-on-month in January, is the highest number almost seen in a year. Okay, so if you look at it over here, okay, this jump is almost the highest in the year. So this print itself, right, I would say it's more like an outlier. Why? Because usually at the start of the year, in the every start of the year in January, businesses in US tends to actually increase their, we call it their menu prices in terms of goods and services before the start of the year. So that tends to be a kind of an outlier. What's consolidating the fact is that the month-on-month print, the year-on-year print, pardon me, the core year-on-year print came down slightly below. Okay, where's the core year-on-year? 1 second, give me a minute. Okay, I think I got to change the, my apologies, let me change a bit. Yeah, here's, so the core PCE print on a, that means we remove off the seasonality impact. The year-on-year number came in at 2.8%, below the previous print of December at 2.9%, and we in market expectation of 2.8%. So that isn't kind of a scary, what I call that, elevated inflationary pressure that is being prevalent in the US, we call it economy at the juncture. So you look at it over here, this is actually deceleration. All right, deceleration is in progress. So that actually indicate to us that there are higher chances of the Fed cutting interest rate rather than hiking interest rate in 2024. So that actually explained to us that number one, the Fed is still in a interest rate cutting mode potentially, rather than going back to interest rate hiking mode. All right, so that actually explained to us the market reacted positively in terms of the global major benchmark stock indices, and plus the European indices as well, that is still operating upon the release of this US PCE data. So the SPX and the Nasdaq 100 actually rallied to fresh all-time high. The SPX added 0.52%, the Nasdaq 100 0.95%, that's close to 1%, supported by the US mega cap stocks, the tech stocks, especially the NVIDIA, that is actually riding this, leading this, we call it ongoing, risk on rally, or up, or I would say that a short-term uptrend phase that's still intact in the major US stock indices. The Dow Jones and the Russell not too far behind. The Russell 2000 added 0.7%, and the Dow Jones Industrial average 0.12%. So if you look at the heat map of the S&P 500 over here, is indicating to us that the biggest gainer so far was the semiconductor, where the AI optimism are still pretty much intact. So do not forget over here is that we are looking at things from a very short-term perspective. So from this, the daily dose of market insight. So from a short-term perspective over here is that, yeah, we can argue the fact that there's a lot of optimism inside the semiconductor space. Then from a technical analysis perspective, we ask ourselves, is there any trend exhaustion? So like I actually share with you all by looking at those short-term technical chart on an hourly basis. So the answer to us right now seems to me that it's more the higher probability that skewing is towards more on the bullish trend. The short-term bullish trend is still intact, rather than trying to pick that this is the ongoing potential major top in the semiconductor space, because we see lots of optimism coming into NVIDIA. So because we got to respect the short-term momentum that is still prevalent in NVIDIA and the semiconductor space, that is now spreading on towards the positive feedback loop right back into the major US stock indices. All right. Okay. So give me a minute for a while now. It seems to me that there is some distraction in terms of my voice or my background voice. Let me do a check right now. If you don't mind, let me pause for a while. All right, I'll be right back. Okay, I'm back now. So hopefully things are better right now. All right. So where we are, okay, so we are talking about the current ongoing momentum of the semiconductor space led by NVIDIA. Yes, a lot of us may say that, hey, there's a lot of rampant optimism going on in the semiconductor space at NVIDIA, but we still got to respect their short-term momentum, which indicate to us that there is still no clear signs of a short-term momentum exhaustion. That means, i.e., potentially this positive feedback loop could be still intact, that is start to spread into into the major benchmark US stock indices, leading to them to actually scale higher high and higher low. All right. So with that, that is the key, we call it takeaway I share with you all. And also don't forget over here is that there's this important inter-market correlation between the risk-on behavior in the US stock indices, together with the indirectly related to the 10-year US Treasury yield, which is the cost of funding. So if you look at the US 10-year Treasury yield, yesterday's price reaction on the US 10-year US Treasury yield also supporting this ongoing risk-on behavior, where the 10-year US Treasury, as I mentioned earlier, continue to be sluggish below the lower limit of that 4.33/4.55 major resistance zone. Is still trading sideways, neither here nor there, still holding above a key near-term support at 4.14%. So as long as it didn't break into this 4.33%, that actually explains that ongoing short-term bullish momentum that is being played out right now in the major US stock indices. So for dollar story, the dollar story yesterday added a bit of strength at positive 0.22%, but still holding. If you look at the dollar index, all right. Okay. That was yesterday price movement after a fourth retest as the key near-term support area at 103.70, but still holding below the 104.85 level, the key resistance level. All right. And today's Asia session, there's a bit of dollar weakness coming back into the picture as well. So later I'll explain why, because of a pretty strong data print from China. All right, so then you have gold. So gold itself was actually another beneficiary yesterday from that lackluster US 10-year lackluster movement in that US 10-year Treasury yield that remains sluggish below 4.33% key resistance level. Why gold actually managed to stage a rally? Because like I mentioned earlier on, gold itself also have a negative correlation with the US 10-year Treasury yield. So as long as the US 10-year Treasury yield didn't break above 4.33%, gold itself faces a lower opportunity cost of holding gold. Because as you know that gold, if you hold on to gold, gold is a zero yielding asset class. Okay, that means it don't give you any fixed income. Okay, like bonds or so, or even stocks. So gold price as they managed to break out above that short-term range resistance level being our anticipation at the 2042, rallied up to I think 2050 level mark. At the end of the US session, spot gold, that means that's XAU/USD, managed to actually have a daily gain of 0.48%. And for West Texas oil, it closed almost unchanged, still whipsawing around that $79 per barrel mark. All right, so with that, what are the key data to look out for, to actually to highlight to you all before we jump straight into the short-term technical outlook? What we have today over here is that earlier on we have the China manufacturing PMI data that was released. So one thing very positive about the China PMI data is that the manufacturing sector in China continue to contract, but the pace of contraction has started to slow down. So previous month was 49.2. So anything that's below 50 is contraction. All right. So 49.2 was printed in January last month. This month came in at 49.1. So if you look at the trend of this piece of contraction, it actually started to slow down since October last year. And what's interesting over here is the services side, the non-manufacturing PMI continue to expand, and it expand much more than what is market is expecting. Consensus figure is at 50.8 for February, pardon me, but the actual print came in better than expected at 51.4, above 50.7 in January. So if you look at the trend of the services sector in China, we call it the non-manufacturing PMI in China, the data actually also starts to improve modestly as well, slow and steady, holding above the 50 level. And the February print of 51.4 is actually the strongest pace since September last year. So this also, the month of February is very important. Why? Because it takes into consideration of the Lunar New Year Golden Week holiday in China that just concluded not long ago. So this indicates to us that China consumers has started to open up their pockets and spend during the holiday season. So that's actually positive for China as well in terms of the economic status. So, and also reduces a slight reduction of the odds of this ongoing deflationary risk spiral in China, and which also could also continue to support our technical view that the short-term ongoing counter trend rebound scenario is still pretty much intact on the Hang Seng Index. All right, so with that, let us now straight away jump straight into the short-term technical outlook. Okay, let us start with the major stock indices first. So the major stock indices for Asia session, the one that has the biggest, we call it positive movement, will be the Nikkei 225. So this is my Nikkei 225 chart. Okay, so let me expand my screen. So you still recall that yesterday we highlighted a very, very clear potential short-term bullish reversal scenario right at the 38,850 short-term pivotal support that I've been highlighting since last week, indicating to us that yes, even though the Nikkei 225 scale new highs, it doesn't show any signs of a bullish exhaustion, and potentially this short-term ongoing uptrend could continue its impulsive up move sequence, which start to play out as expected as we've seen on my chart today. So what we see over here, we see a strong burst off right at the 38,850 short-term pivotal support that we've been highlighting since last week. But this push up in price action now is coming very close to the resistance level that we highlight as well, 40,090. So with the RSI now at a relatively extreme overbought level on the hourly basis, but there is no signs of a bearish divergence. That means no what I call lower high in price action yet. Price going to go higher high in the hourly RSI. So indicating to us that there's maybe a risk of a slight pullback. Okay, pullback to where? Pullback potentially to 39,600 level, which is the former minor swing high of last Friday. So we will have a tightened key short-term pivotal support level for today. This potential pullback, as long as I don't want to tie it so tightly to 39,600, I'll use 39,280. So what's 39,280? Graphical level, former graphical congestion level, as you could see on my screen over here, 29th of February, 1st of March today, pulse up, and also the 61.8% Fibo retracement pretty much closely of the entire current short-term impulsive up leg move. All right. Also the golden ratio. So as long as any potential pullback managed to hold above this tightened key short-term pivotal support at 39,280, the next resistance to watch out for will be at 40,490 / 40,690. Fibo extension cluster level, you could see on my screen over here, and as well as the upper limit of this medium-term ascending channel that I drew from the low of 4th of Jan. Only an hourly close below 39,280 will negate this bullish tone to see an extension of that minor corrective pullback to retest 38,850, which is this Thursday minor swing low area. All right, now Hang Seng, which is the Hong Kong 33 index, we call it on platform, continue to burst up as well after today's retest of that short-term pivotal support level at 16,350. You can see over here a very strong bullish reversal hammer candlestick after the test on it. All right, so with that, no change for sure. 16,350 will be the short-term pivotal support level to maintain this short-term bullish outlook on the Hong Kong 33 as it's continue to evolve within this short-term counter trend rebound scenario that is still intact from the low of 22nd of January, as price action going to oscillate within this minor ascending channel. Next resistance level to watch after 16,860 will be the next resistance zone at 17,010, 17,130 Fibo cluster level, extension cluster level, as well as the minor swing high of 28th of December and 2nd of Jan. Only an hourly close below 16,350 will negate this short-term bullish outlook tone to see another round of a choppy corrective decline to retest 16,140 / 15,950 support zone. While this support zone, it confluence with the 20-day moving average and as well as the lower limit the lower limit of this minor ascending channel that is in place since 22nd of January 2024. Another one will be the German 30 bullish bullish up move accelerating after the breakout of this the push up above this upper limit of this minor ascending channel that I drew from 14th of February low. So what we could see over here is that yesterday we do have a first resistance level at 17,680, 17,730 level. So now this will become a pullback support level right now, which is also the former upper limit of this minor ascending channel upper boundary, now turns to a pullback support right at the 17,730. So with that, I will not want to use 17,730 as my key short-term pivotal support today. I will tighten it to slightly much higher to 17,690 level, which is the median line of this minor ascending channel. And also, if we do the Fibo retracement of this ongoing impulsive up move, short-term up move from 26th of February low all the way up to the current intraday high, it also corresponds closely with the golden ratio of 61.8%. And why do we say that potentially this up move over here, there's lower risk of a bearish reversal? Because the RSI, the daily RSI, is not showing any signs of clear bearish divergence at this point in time. So with that, any potential pullback that is managed to hold above 17,690, we will still maintain that short-term bullish outlook on the German 30 index. Next resistance, our 17,890 level. Above this level exposes the next resistance level or a next intermediate resistance level, which also correspond to a Fibo extension cluster level at 18,050/18,100. Only an hourly close below 17,690 will negate this bullish tone to see a deeper minor corrective pullback to retest the lower limit of this minor ascending channel, also acting as a support at 17,450. Major US stock indices, the Dow Jones Industrial Average continued to hold steady yesterday, above the short-term pivotal support that we have, 38,770, managed to shape a higher low, and a higher low also has been seen on the hourly RSI, now inching back up above the 50 level mark. So no change, going to be maintain that bullish outlook, short-term bullish outlook on the US Wall Street 30, as long as 38,770 short-term pivotal support holds for today, breakout above the intermediate resistance or near-term resistance at 39,100, potentially exposes the next resistance level at 39,400 on the US Wall Street 30. Only an hourly close below 38,770 will negate this bullish tone to see another round of much more a pronounced minor corrective decline to retest last Thursday's swing low area, now acting as a support at 38,000, I think at the next support at 38,430/38,360. Nasdaq 100. So Nasdaq 100 going to pierce up and shape a new all-time high level. Okay, so next resistance level to watch will be at 18,220/18,270. So I will tighten the key short-term pivotal support level for today using this Thursday minor swing low area, also confluencing with the upward sloping 20-day moving average, coming to act as a support together at 17,810. So as long as any potential pullback level, okay, so the first pullback level to watch, right, for sure for today, okay, will be this level, okay, because this level now turns into a pullback support, okay, but I don't want to tie it so tightly at 18,000 level as my short-term pivotal support for today, because I will get whipsaw out. So I will use 17,810. So as long as any potential pullback level manage to hold above 17,810, I will still maintain this short-term bullish bias on the Nasdaq 100. Above 18,270, that's the first resistance, exposes the next Fibo extension cluster level. Now will be the next intermediate resistance to watch at 18,410/18,470. However, if we have an hourly close below 17,810, we will see the extension of this minor corrective decline to test the next support level at 17,560. Minor congestion area of 20th of Feb and 21st of Feb, and as well as this minor ascending channel lower limit that is in place since the low of 5th of January that I drew over here. All right, so overall net, all the major US stock indices that I covered with you are still evolving within their respective short-term uptrend phases and still holding right above their respective short-term pivotal support level. FX market. So FX market, let us start with the European currency. So no change in the European currency, pretty much sluggish as well, but still holding above their short-term pivotal support for the euro dollar. As long as 1.0810 short-term pivotal support holds, we will still maintain that short-term bullish outlook for a potential, we call it a range-bound configuration play, with the first resistance level to watch for sure will be at 1.0890 that has kept previous up move since 22nd of February. And also right now the 50-day moving average also coming close to it to act as a resistance at around 1.0890. Only hourly close for sure a breakdown below 1.0810 will negate this short-term bullish bias within a range view to see a further push down to test the next support level at 1.0785/1.0760. sterling dollar. So for the sterling dollar over here, continue to actually churn, still holding above the short-term pivotal support level that we have yesterday at 1.2610, managed to survive at this level. So still maintain that short-term bullish bias within a range configuration, 1.2610 short-term pivotal support. First resistance to watch will be this range resistance level that is in place since 22nd of February at 1.27 figure level. However, an hourly close below 1.2610 will invalidate this short-term bullish outlook view to see the extension of another round of choppy minor corrective decline to retest the 200-day moving average, now also acting as a support at around this 1.2560 / 1.2540 support level. Asia Pacific currency. So let us start with the Aussie dollar. So Aussie dollar, yesterday we do have a bearish bias below 65.30. Then we are looking for the support level to come in at 64.70. So yesterday it printed a intraday low of 64.87 before bouncing up over here. A bit of mixed element right now. Why do I say mixed? Because the way it bounced up over here, the RSI has started to shape a very clear bullish divergence on the oversold after hitting the oversold level yesterday, and start to shape a higher low, while price action going to shape a similar low, I would say. So with that, right, I will start to have a neutrality stance instead because of this mixed element. So flipping to a neutrality stance for today for the Aussie dollar, from the previous day of a bearish bias. So neutral between 65.30 and 64.90, which was yesterday's minor swing low that was tested twice. All right, so neutral between these two levels, 65.30 and 64.90 for now on the Australian dollar. Dollar yen. So dollar yen, yesterday it actually floated down right at our first support level before bouncing up. So the way it bounced out over here, if you look at the Fibo retracement, taking into account of yesterday's push down, it actually now stalling close to the golden ratio, which actually right below the short-term pivotal range resistance of 15070 / 15080. So no, still no change, still using 15070, 15080 as my short-term pivotal range resistance key level to maintain that bearish bias on the dollar yen. So first support level to watch for sure will be the range support level again at 14960. Only a clear hourly close below 14960 exposes the next support level at 14880 / 14840. Only an hourly close above 15080 will invalidate this short-term bearish bias view on the dollar yen to see a squeeze up to test the major resistance zone of 15140 / 15195. Spot gold. So spot gold going to be bullish. So yesterday it managed to stage a breakout of 2042. So what's 2042 is actually the upper limit of this potential symmetrical triangle range configuration that I drew from the high of the 20th of December. So now 2042 level will be the pullback support level where price action try to pull back and bounce off right now. So I don't want to use the 2042 level as my short-term pivotal support for today. It's a bit tight. So I will, to prevent any whipsaw, I will use a slightly lower levels, but still a tightened pivotal support. So those who could recall previously, our short-term pivotal support level will be at 2022. So for today, I will tighten it to 2030, slightly below the 50-day moving average, acting as a support level as well, and also be right below this minor ascending trend line that I drew from the low of 14th of February. So that as long as any potential pullback managed to hold above 2030 level, short-term pivotal support, we will still maintain a short-term bullish bias on spot gold. Next resistance level to watch 2059 / 2064, which is the minor swing high area of 5th of Jan, 13th of Jan, and as well as 1st of February. Only an hourly close below 2030 will negate this bullish tone to see another round of choppy minor corrective decline structure to retest the minor swing low area of 2016 and 2011, this congestion area over here, and as also conferencing with, I believe it's the 50% Fibo retracement. All right, 50% Fibo retracement and slightly below the 61.8% Fibo retracement, or conferencing slightly at this 2016, 2011 support level. Okay. So IE still maintain that short-term bullish outlook on spot gold as long as tighten key short-term pivotal support holds at 2030. So no change for oil. So WTI West crude oil going to be very, very choppy. So still maintain that West Texas oil still maintain that neutrality stance between 79.80 and 77.50 for today. All right. So before we go let's take a look at the economic calendar. What are the key things to look out for? So the key things to look out for today will be the US ISM Manufacturing PMI data. So manufacturing IM PMI data, even though it's in contraction mode, the contraction mode continue to be lesser. So market is expecting a slight improvement to 49.5 from 49.1 in February. And what's interesting over here is take a look at the manufacturing prices. So manufacturing prices considered is very similar to production prices, input prices. So if production prices going to be relatively high, it could have a negative spillover to the CPI and the PCE numbers going forward. So over here, market is expecting a slight uptick only to 53 level, slightly from 52.9. So any number that is above 53, let's say we're coming in at around 55 level, so that could actually potentially put a bit of damper or a bit of pullback to actually being seen on the major US stock indices. Why? Because any number that's 55 and above could potentially see a slight uptick in the US 10-year Treasury yield. So something to monitor, a key data to monitor within the ISM manufacturing data that is going to be released at 11 p.m. Singapore time. So with that, that pretty much sum up for today's Daily Dose of Market Insights. So with that, have a great day ahead, and I wish you all an excellent weekend, and we shall speak again on next Monday. Thank you.